Hi everyone, Andrew here again. Over the past 4 years, to going back to 2020, the investment markets have been particularly volatile, have been swinging about all over the place. We had the very bad start with the COVID years and a quick recovery in the second half of 2020. Then we had a slightly more positive 21 and a very bad 2022 when we had the war in Ukraine start and the cost of living crisis. And then 2023 has seen a bit of a recovery, or a strong recovery, and 2024 has continued to be positive. So I'm conscious that it might be hard to understand, particularly if you're new to investing, or perhaps more cautious, really to get a sense of what normal looks like in investment terms, if indeed there is such a thing as normal. So I wanted to use this video just to provide you a bit more insight and a bit more information to just increase your understanding of this complex, or what seems to be complex, world of investing. So what I'm using here is data provided again by my investment partner, EBI Portfolios Ltd. And what I'm going to show you is how investment returns have varied with different with a long term going back to 1956. But what typical investment returns look like. So what I want you to do is to cast your minds back to your school days and your math lessons, if that's not too scary a thought. And if you can remember what in mathematical terms called histograms, but in regular layman's terms called bell-shaped curves. And a bell-shaped curve just shows the distribution of returns and the frequency of those distributions. And it can be for anything. It could be for how pupils in a class do in a particular test, and the range of different test scores. It could be how a particular football team forms in a football season, and the frequency of their placing in the league table. Could be anything really. What I want to show you is the distribution of returns for particular portfolios over the long term, and I'm going to do that step by step, and hopefully make it as clear and concise as possible for you. So what we're looking at here in this table is a portfolio that's been invested since 1956. Now, as with previous times I've shared this sort of data, most of the data is simulated returns because the portfolios haven't been around really that long, a 68-year period. And we're looking at, first of all, at a portfolio that is 60% invested in global stock markets and 40% in global government bonds, so the lower risk end. And what we've got along the bottom here is the range of returns from negative, very scary, minus 14%, to positive 14%. And it's looking at monthly returns. So those returns in any monthly period split into 1% ranges. So this bar would be 0 to 1%, 1% to 2%. And this takes a classic bell-shaped curve, pretty much a classic bell-shaped curve. So what it's showing you, that the most frequent returns are in the range of a 1 to 2% return each month. So over the 817 individual months over this 68-year period, 142 of those months has seen a range of return between 1 to 2%. And the next most frequent is in a 2 to 3% return. So on 133 months in the total 817 month frame, 133 have been in a 2% return over a month. Now we do get scary returns. There was 1 month where the portfolio lost 14%. Most of the time you can see it's distributed around the middle. So we've got quite a few occurrences, 190 occurrences of monthly returns that have been either 0 to -1 or -1 to -2%. We've got some very exciting returns here. We had 1 month of a double-digit 11% returns. But as you expect with a bell-shaped curve, most of it is distributed around the middle. An important point to see is that when you're investing, by far the most frequent occurrence is that we get positive returns. We have to accept we have periods of negative returns, but they do the positive outnumber the negative quite considerably. Now that's on a middle of the road portfolio on a monthly basis. If I just click this button here, we can see how the distribution range. If we look at annual returns now, that doesn't quite meet that nice bell-shaped curve, but you can see out of our 87-year period, again, by an overwhelming majority, we have more positive years than we have negative years. The most frequent distribution, that's there have been 7 years out of that 87 where the markets have returned in the region of 8 to 9%. Otherwise, they're fairly evenly scattered. A lot around the sort of exciting 1 to 5, 7%, with a few occurrences where it's been 13 to 14% return. But of course, we do have those scarier times, years when it's been double-digit negative returns. When they have been negative, they've generally been single-digit negative. So we mustn't ignore the negatives, but we must console ourselves or give ourselves confidence that when we invest, we know most of the time we can expect positive returns. Now that's looking at a balanced medium high investor. What if we look at a higher risk investor, someone's investing in the stock market, 100% in the stock markets? If I go back to monthly returns, you can see it still has that classic bell-shaped shape to it. We get some bigger, scarier numbers. So there's been one year, which I suspect was probably 1973, maybe 1974, when we had a 24% return. But again, by and away, the overwhelming majority have been positive. And the largest range of returns on a monthly basis is at 2 to 3%. Monthly returns, 87%, 87 occurrences of that. Again, if we look at that on an annual basis, we can see it's pretty broadly spread, but again, nearly 50 out of the 87 occurrences have been positive. One particularly scary year there, again, probably up to 73, I would have thought. 73 or 74, we had a minus 30% return. And then just to complete the picture, we look at someone who's very low risk, entirely in low risk government bonds. You can see the range of distributions is much greater. We're still getting some negative returns, but rather than those double-digit returns, we're only looking at a minus 4% as at worst, and that's been there's been 2 months where there's been a fall of minus 4%, and then the 5 occurrences where the monthly returns have been 5% or more. But 517 out of the 817 have been in that range of 0 to 1%. So we know when we invest in low risk funds, the volatility, the range of returns is much smaller, but we're not getting the big upside as well. Just again, to complete the picture there, if we look at the annual returns, you can see only 3 occurrences when we're getting annual returns being negative. A couple of very strong months for a low risk type of investment. Most of them congregated around sort of 4, 5, 6% per annum return. So I hope that helps. I hope that helps give you a bit of more understanding about what to expect when we're investing. So we've always got to expect the periods of very high returns or very low returns. Most of the time, most months and most years will be congregated around the middle of the range of returns and on the positive side of things. As always, if you've got any questions, please do get in touch.